think, act, and prosper. You are now tuned into the Money Level Show.
Hey everyone, welcome back to the Money Level Show, where we think, act, and prosper. Here we're talking all things macro. We might get a little bit into the micro today, but today I got my guy Giorgio from Avant-Gardia Investment Media, and so we're gonna get back into it. He actually came onto the channel recently, and he made some pretty bold calls. Some would say. I mean, some people think that the markets go all the way up and they never come down. And he actually made some really good calls, and those calls were actually spot on. So we're going to invite Giorgio back today. How are you doing today?
I'm doing very good. Thank you. It's my pleasure to be here. Thank you for inviting me.
Yeah. You told me before, you were like, hey, liquidity's drying up, stocks are going to fall. You can sell your stocks, buy lower, and then, they'll probably go back up. But, especially with the talk about recession and everything, you had mentioned that, and it was actually spot on. So congratulations, man.
Thank you. I mean, I don't consider myself anything but an expert, but I follow great people, and I try to listen to very smart people. And there was one point a couple months ago where a lot of people, really smart investors, were trying to warn participants about what was coming. And I felt like the signs were there, the warnings were there, but the market was just ignoring them completely. So stocks were continuing to go up, the market was rallying, but the macro wasn't there for sure. Like and that's why I thought that being more defensive at that point was a great idea. So for sure.
You were all cash, weren't you?
Yeah, I was 100% cash with some shorts. So like I'm structuring my shorts through options. So I use long-term options, which gives me a peace of mind that's greater than just regular shorts. Because when you regular short anything, you borrow the shares. Let's say you short Apple, you're borrowing shares of Apple, and then you're selling them directly into the market. And usually you borrow them through your broker. And then you hope that the price goes down, and then you can buy them back and give them back to your broker and make the profit. And the problem there is that since you're borrowing something, if the price goes against you, you need to close your position to buy the shares back at a much higher price. And also every day that goes by that you're borrowing this share, you're paying interest. So that doesn't really, it's not the perfect situation for me. So I like to use options. So I know that my risk is clearly defined. When I buy a put, the maximum I can lose is just the price of the contract. So yeah.
So when you say short, so the first example that you gave of how you were doing, are you talking about cash secured puts?
Oh no, I would just buy puts in the market when volatility is low, so you can see the VIX level. So it's of course, if you buy in puts when the VIX is expensive, let's say over 24, over 25, or even over 30, you are paying a lot of premium to have this protection on a market downswing. But if you're buying them when they are like the VIX in the low 20s, especially during a bear market, if the VIX goes to the low 20s, that's a perfect opportunity to buy protection. And we've seen this recently with violent bear market rally that we have seen. We have seen stocks go 20% higher from the June lows, and that was a great opportunity to go back into shorts. And that's what I did. I gradually bought back some short exposure on the market, especially Apple. Apple stung a little bit because I didn't think Apple was going to go as much so high. It got to $176. So like 4% from all-time highs. I thought the maximums could have been probably 160. So I began shorting Apple through options, long-term options that expire in 1 year or more. when it was 155, and then I added slowly. And the last I added was when it was near the high that it got now in August.
Yeah. Those are hard to. It's hard to. For me, it's hard to have patience with a lot of those options because you're just seeing like your premium or your option value just go down. Like so, when you mentioned like the VIX, when we had the bear market rally, that bear market rally was violent, and so I went to look at like the VIXy, which is the VIX ETF or whatnot, and then also looked at the QID, which is like a short QQQ, and those were actually cheap, at that point. And so I did buy some options in those because I was like, okay, these are cheap. I know that we're in a bear market rally, and I know stocks are going to turn back around at some point. It was kind of hard to tell, what was going on because like the market interpreted the July Fed speech by Powell as that Powell was pivoting. And that's what kind of sparked that bear market rally because he didn't give any forward guidance. So what was your take when Powell came out? He didn't really give forward guidance. This was in July when he came out and spoke at the end of July. And he didn't have a plan for interest rate hikes at that point.
Yeah, what he said basically, he said that from that point onwards, it was going to be data dependent, which is like, it means nothing. So what it means is that, of course, if inflation was going to come down substantially or unemployment was going to go up substantially, he was going to, I don't even want to use the word pivot because it's like they made it clear that their inflation target is 2%. And we are like way above 8. So it's like, it wasn't a dovish Fed for sure. And I think the most important thing and to do during bear markets is to study what some experts call secondary reactions, or they are also called bear market rallies. So I think the most important thing is to understand the nature behind bear market rallies and the psychology behind bear market rallies. So how the bear market rally happen, how does it get formed, and what's the sequence that it goes through, and how to, especially the most important thing I would say is to, which is probably the easiest thing to do during bear markets, is to be able to differentiate between a bear market rally and a new bull market. So that's the most important thing, because if you can differentiate between a bear market rally and a new bull market, you can position accordingly, because you know that, yeah, the market is going higher. Yeah, it's probably going to go higher for quite some weeks, also violently. But if you know that's just a bear market rally, you know that eventually you're going to see new lows. So your whole perspective is completely different. And the way you recognize that, it's pretty easy. It's a technical reversal without fundamental improvements. So whenever you see a technical reversal in the market, which is usually in bear market rallies, is fueled by shorts covering, and you can go look it up, how much hedge funds are trying to cover their shorts. And if you go and you look at the stats, the bear market rally that we had, we experienced the most short coverings in like the last decade. So it was clearly like the first leg down of the market that went down to the June lows was clearly overdone. It was clearly oversold. A lot of people were going short. Too many people were going shorts. Even retail people were going shorts. So then what happened is that hedge fund manager, they were just like, hey, they are sitting on healthy profits because they were short since like a couple of months. So they were starting covering. And so when they cover, the market goes up a little. And then when the market goes up a little, the retail people, they shorted the whole, they try to say, okay, I need to short because the market is going higher. So the market goes even higher. At that point, momentum trader come in and they are just going along with whatever momentum is telling them. So in that case, it's like the long trade. And so the market goes higher. And then at that point, people try to think that it's a new bull market. They are really convinced that it's a new bull market. I mean, when the Nasdaq was 20% above the lows, we saw headlines saying, "Oh, Nasdaq is a new bull market. We are approaching. We are not so far from all-time highs, and everything is cool. Everything is fine." But of course, that wasn't the case. So, and then that's exactly when the bear market rally actually ends, is when everybody turns bullish. So now the market can come down again. So the main important thing is to see a technical reversal without fundamental improvements. So whenever you see that the market goes up on technical reversal, such as short covering, but at the same time, you see economic fundamentals not improving. So you see, for example, consumer sentiment was going lower. Inflation actually, the July inflation, okay, that came down a little bit. But what I'm saying is that the June inflation was still high, and consumer sentiment is low, disposable income is low, people are not really that comfortable about the economy, so probably it's not a new bull market, and so you need to position accordingly, and you can like start shorts, or you can sell if you have long positions. Now you have an opportunity to sell.
Yeah, for sure. Yeah, and I actually got short squeeze in that. Which one? What was it? I was playing puts on the SPY. I was telling, it was funny because so I hedged the puts with calls, but I was so stuck in my mind like the market's going lower. I was like, inflation's coming out, the Fed's coming out. I was expecting like how the previous months had played out, because the SPY would pop on inflation news or the Fed, and then when the Fed raises rates, and then it would tank the next day. This time, like I had some call options. The call options I bought were just a hedge, and they were like way outperforming the put options that I had. And so my put options were getting killed. And so I was doubling down on the puts, like, the market's going lower. And then, I sold my calls off, and then my puts were just decimated. I got up out of those positions, and then the calls where I sold the calls, and the calls went to like over, like $1,000-$2,000, and I was like, why did I sell those calls? But I was so stuck in like the market was going lower, and the bear market rally was fighting against me. So I was so I got short squeezed, and when everyone was bearish on what was going to happen.
Yeah, I think it's what really kills investors during bear markets is just bear market rallies, because it kills both investors, both the bulls and the bears, because bears get squeezed and bulls think it's a new bull market, so they pile new cash, new money into the market, and then they get killed in the subsequent leg down. So bear market rallies are really what kills investors, and that's why I think it's so important to be able to distinguish them from new bull markets. And that's the main key. And like one thing that I want to do, and I do, is that once the bear market rally retraces 50% of the previous lost ground, I try to add shorts, but small shorts. So it's important to stay small, and it's important to position oneself so that you don't get squeezed if you eventually get right. So the main problem is, like, let's say your put options were going to be in the money 1 year from now, because the market was going to will go lower eventually, probably, let's say. But then you got squeezed and you bought back, you sold them, so you lost that chance. So I think the most important thing is to play with long time frames. So let's say if you buy put options, you buy them that expire in 1 year or more, and then you just write it out, because you know that the main trend during a bear market is down. So you can have bear market rallies, but the main trend is down, so you're okay.
Mm-hmm. Yeah, for sure. Yeah, that was heartbreaking for me. I told myself I'm not playing options for a while. And so, but this is also like my first participating in my first bear market. So a lot of, like I feel like my head's on right, as far as like where the trend is going, but like watching these rallies and such, like it's I'm learning a lot, as well from experience. Like I think this experience of me getting short squeeze, is helping me learn, and I feel like the lesson I learned there is that, I can't, obviously you can't invest based off what happened the prior month. with the Fed raising rates and then the market going lower. And then a month prior to that, the Fed raised rates, the market went lower, and such. And then, so you can't just bet on that, every month that's going to happen. And so doing more long-term options, put options would be more wiser in that situation. So, even with all this being said, like we haven't even got an official announcement of a recession yet. We had, the United States president, they came out and they tried to redefine the word recession. And I feel like that's delaying a lot of the pain because we have not seen capitulation yet, where sentiment gets really, really, really low, and we haven't seen capitulation yet.
Oh yeah, for sure. And I think most bear markets, looking at history, can be divided in three phases. So the first phase would be the phase where investors realized that they were too bullish about the growth expectations, and their growth expectations were not going to ever realize. And so the first phase is characterized by valuation compression. So valuation just come down. So let's say the market was too hot on a valuation standpoint. So let's say the PE of the market goes from 25 to 20. And that's like the earnings still come out okay. Companies still can beat earnings. And that actually what happened right now. Like a lot of companies, a lot of people thought that the Q2 earnings were going to be a disaster, but that wasn't the case. So like, let's say Apple beat estimate, Microsoft did, like a lot of companies beat estimates in Q2 because the first phase of the bear market is just a valuation compression. So we go from a high PE to a more normal PE. Then the second phase of the bear market is when the actual recession hits the companies. So you have poor fundamentals, a deteriorating economy, and then you see companies having bad quarters. So like the earnings come down, unemployment goes up, and that's what kills the market further in the second phase of the bear market. And we haven't seen that yet. I think this is what we have in front of us for the next months. So I feel like for sure, September, October, November, in September, we will see the first companies report. In September, October, we'll see companies report Q3. And I think it's where we will see for the first time some pain in earnings for companies. And I think earning estimates for the S&P 500 earnings are too high right now. They will come down. And so the second leg of the second phase or second leg of the bear market is earnings compression. And of course, if the PE, let's say, if you have, so the PE is price earning ratio. So if the earnings go down and the PE stay constant, the price needs to go down for sure. So that's what is going to bring stocks down in the second phase. And the third phase, it's the capitulation phase. That what we were referring to is the last phase of the bear market. It's the phase where everybody needs to sell what they have in the market just because they need the liquidity, because probably they lost the job or they need an emergency cash fund for something. And that's where everything goes down. Gold goes down, even though gold usually goes higher during recessions because people are afraid about when there is fear in the markets, gold does well, but not in the capitulation phase. The only thing that saves you in the capitulation phase, which is the last phase of the bear market, is dollars, because being the reserve currency, there is a demand for dollars during the capitulation that's really great. So everybody's trying to sell dollars, tries to sell everything to get dollars. The second is exposure to market volatility. That can be, if you have put options on the market, now you get really good exposure on that. And the third is just short-term treasuries, because they're like cash equivalents. And that's for the last phase of the bear market. So I think now we're entering phase two, and later next year, we are probably going to see capitulation. But now we're entering phase two, and now we're going to see earnings come down, companies to have to lower their outlooks. It's coming. I think it's coming next month for sure.
Yeah, that's I agree. And I'm kind of wondering like how this new dynamic. So like here in the U.S. we have we just Biden just forgave the student loans, right? And
Yeah.
he also delayed the payments till December 31st. So there's a lot. I think there's a lot of people that otherwise would have less cash or kind of having that extra cash through that delaying of the payments, and then he also forgave, up to 20,000 in student loan debt. So I don't know how much that affects the market here or whatnot, but I know that it kind of gives people like a little more cushion. Like, because even for me, like I don't have to pay, for another, 3-4 months, and so like that's money in my pocket. Like, you know what I'm saying, that I can
Yeah.
go and speculate in the market or whatnot. But so I'm wondering how that may impact earnings or whatnot if people are still spending like extra cash on things they don't need or whatnot. So that's kind of one of the things I've been thinking about. I mean, if you have anything to share on that, I mean, do you think that's going to make an impact or not?
I think it's going to be it has an impact for sure. I think it's more of a political move, of course, because of midterms. But I think it's this thing. I think the most difficult thing to do as an investor is to be a realist, because when you are perma bullish, you see everything as super bullish. When you are perma bearish, you see everything as super bearish. But many times the truth is lays in the middle. So I think for sure it's not bearish news that he's forgiving these student loans and giving this delay, like he until December 31st people can wait until making payments. I think it's actually a good thing, but I don't think it's enough to save the markets. It's not that much. So I think still the economy is deteriorating. Still things are going are going slower, and the economy is going down. It's probably going to slow things a little bit, but I don't think it's bullish. I don't think it's enough, because the Fed is still like tightening. Now in September they are going to ramp up the pace of QT. So I think, and also probably the most important thing that everybody needs to remember is that all the Fed tools, such as raising interest rates, have a lag until the true effects are seen into the economy. So they started raising rates not that long ago. And we can wait even 1 year to see the full effects of raising interest rates. So right now, we don't see the effects, the full effects of the rates that we have right now. So even if the Fed stopped tightening right now and stopped raising interest rates right now, things would still deteriorate in the next months, because the effect would propagate, and we would need the next months to see the full effects of what has already been done so far.
Yeah, yeah, that makes sense. It comes with that lag because I'm just thinking of like, the political move for the midterms, like, releasing from the Strategic Petroleum Reserve, like suppressing the price of oil and gas, and then also like, the student loan forgiveness and everything. And I feel like if we were to see a whole lot of, let's say inflation didn't come down a little bit. Like a lot of people are anticipating peak inflation and everything, and so you have a lot of news articles about that, and so I think that it's kind of like a mind game in a way to win votes, because I mean the midterms are November, right? And so October, November, people are going to be voting, and we may not see the effects of QT immediately, and further interest rate hikes. We may not see that immediately. And so I'm kind of just like thinking like, okay, like, that are we going to see the market go a lot lower before midterms? Because it seems like they're trying to suppress like inflation, and then they're trying to give money, pretty much. I did a video a few months ago about the student loan forgiveness, and I said it was another stimulus, and some people like were were like arguing with me and, you know, and laughing and stuff like that. And then sure enough, here it comes, you know, and I'm just kind of trying to process, like, not necessarily the timing, but just like, you know, they're obviously doing this for a reason to get more votes. But I feel like if inflation goes higher, or if the price of oil goes higher, or if the market crashes, you know, that's going to affect their efforts, you know, of trying to get more votes.
Yeah, I think right now it's not the best situation for anybody trying to get votes from people, because people are not happy. They're not happy because there is a high inflation. They're not happy, and they're not going to be happy in the future because they're going to lose their jobs, unfortunately. So, but I do agree that inflation needs to get tamed, and it's the biggest problem because inflation eats 100% of the population, while recessions hit only a portion of the population. So, for sure, it's the biggest thing, and people get really angry at their governments once they no longer trust their own currency, and that's something really bad. So, for sure, they have to tackle this. And I'll be honest, I don't want to get political, but I think a lot of the inflation problem that Biden is trying to fight was generated when Trump was president under the COVID situation, because the Fed really got out of control on the amount of liquidity they got like in the system. So I think it's difficult to be a politician right now. It's not easy at all, because you get the blame for everything that's happening. At the same time, many things that are happening right now are happening because of somebody did something 4 years ago or 10 years ago, but still you get 100% of the blame of what happens. So I don't know how things are going to go in the November midterms. I don't think markets will be saved by then. I don't think there is anything that can save markets right now, because
I was thinking more of a delay rather than like save. Like, I feel like they're trying to delay it with the SPR, so they stopped releasing from the SPR in, I think, October, November. Then you had the you know, the Inflation Reduction Act to please the ESG crowd, right? And then you have, you know, the student loan forgiveness. So it seems like these things are all coming around the same time of like midterms, like they're trying to delay some type of pain. Same thing with like changing the name, the recession definition.
Yeah, of course.
And then Biden doing the little dance when inflation came down and said that inflation's at 0%. So I feel like there's a political agenda in the midst of like this economic turmoil that we're going to experience, and like they're trying to delay it, you know, until like after those midterms or whatnot.
I think for sure they're trying. I don't know if they will be able to do it. Or let's say they can manage to keep oil down under $100 a barrel until midterms, but then the SPR release stops. And then I don't know if you heard about this news, but the Saudi Minister of Energy, he said that OPEC is ready to act in case the disconnect between the paper market and the physical market continues. In other words, if the paper market, which is the futures market, continues to underrepresent the true price of oil in the physical, which in the physical market will be higher, OPEC is ready to cut production. So let's think about that. Let's think about November. Let's think about after midterms and OPEC cutting production of oil and oil prices going back above 100, let's say going 110, 120. Gasoline prices at the pump would raise again, go higher again, and inflation will go up again. Because a lot of the readings of inflation that came recently, a lot of the reduction in inflation was energy coming down, energy prices coming down. But if they pick up again, that's a complete mess. The Fed then would be forced to continue tightening, and the market would really, really feel pain at that point.
Mm-hmm. Yeah, I agree. And I was also thinking of like, you know, like the issue with like inflation. now is that it's been a while. So like you mentioned how we printed a lot of money during Trump, and I agree, and that's just facts. And we propped up a lot of assets. Housing market went crazy. Stocks went crazy. Crypto, everything. It was so much liquidity, right? But the underinvestment in commodities and oil, natural gas, pipelines, transportation, all those things, that's been going on for nearly a decade. And so, I think that, we have a big structural issue with inflation that's not being addressed. I mean, we just passed the Inflation Reduction Act, and there's nothing in there to bring more supply online. You got things like, the Saudi energy minister, coming out and saying like, hey, we will cap production. And there's also been like some news coming out of the area saying that OPEC is likely at spare capacity, and so we're not addressing like the structural issue of like, hey, we need to bring more supply online. Instead, we're doubling down on like the clean energy initiatives. I mean, which, I'm all for clean energy. I'm bullish on nuclear long term and such, but I don't think that that's going to address this winter. I don't think,
No, for sure.
and there's another aspect of, what is it? We burned a lot of oil last winter. And so the same thing, Germany did the same thing. They burned oil during the wintertime. And so we haven't been seeing those effects because it's been, it hasn't been cold. And so, I think that's going to compound on the problem too.
That's for sure. And then you see news like Warren Buffett buying Chevron and buying a lot of Occidental Petroleum, and he now has the right to buy up to, not the right, but he has been allowed to buy up to 50% of Occidental Oxy. So for sure, he's a great investor. He is bullish long-term oil, and I think we all need to be bullish long-term oil. The only reason why I'm talking my book, the only reason why I'm not long oil right now is because during recessions, demand can fall. And even though demand can fall only a little during recessions, because of course a lot of it's not really affected by a recession, I still don't think it's a good time right now to be long oil or long energy companies. I could be 100% wrong, and energy companies can just go up from here onward, but I don't have that certainty. I don't feel comfortable making that call right now, especially because we talk, for example, about the third phase of the bear market, which is the capitulation phase, where everything gets sold.
Yes. Almost
and
like
at that
COVID
point, even
in 2020.
even energy companies will get sold at that point. The oil price will come down. So at that point, I think it's a great time to buy and to keep for years and years. And so I have a list of companies that I would like. I wouldn't mind to own for the next 20 years. And inside this list, there is a lot of energy names. So Chevron, Exxon, and as you said, even pipelines like Enbridge or Enterprise Product Partners, because also pipelines is like a slightly different business model, which is more resilient, and it has a lot of advantages. As of course a wide moat, because a competitor would need to build the infrastructure. So, but the infrastructure is already there. You have a competitive advantage.
Yeah, for sure. And I think also like, with, like decreasing demand. So the Fed, wants to crush demand, and that's ultimately going to crush like employment. So people aren't going to be commuting to work. so that, I mean, that I feel like that puts a hamper on demand, especially if people don't have, those extra funds, to be able to drive to work, or they lost their job, they don't have to drive to work and things like that. And I don't know how much of that it will be impacted. One thing I see, coming down the line too is for inflation to be a lot more sticky, and I don't know like the end game for the Fed. I do know. Well, I know the end game. I feel like I got the big end game, but like just trying to put it into this context of what we're going through now. Because one thing is like government tax receipts, for example. Like the government isn't bringing in a lot of income to finance their deficits because of equity prices being down, and demand also being reduced, inflation, eating away at a lot of people's wealth. And so like they're not receiving as much income as they need. So that's kind of a piece of it where I'm like, okay, well, how far is the Fed going to go, with when you have the government that's, $1 trillion of deficit, of their budget, every year. And now they're not receiving like this, this income from like asset prices going up or whatnot. And I do know like, with the Inflation Reduction Act, they raised the corporate tax. And so maybe that's a way they can supplement that. But I'm trying to figure out that piece of it too.
Yeah, so I think your reasoning is 100% on point, and it's important to think that way, because it's just looking at the numbers. Let's say how much debt there is, how much income the government is getting in every year. What are
the government's broke, y'all? The government is broke, by the way.
Yeah, I mean, if you were a family, they would be bankrupt for sure. But I think the Fed is going to go as long as they can, and for more than people think, and for more than people expect. Because the reality is that if they don't, and people believe that the dollar is over and that inflation will be here forever, then the whole economy just breaks. So something that Powell said in this speech at Jackson Hole is that price stability is the bedrock of our economy. And it's completely true, because when people stop believing that they can just hold dollars and be okay with it and hold purchasing power, and they start believing that prices are continuing to go high and they will continue to go high, everything breaks. The economy cannot function. So I think the Fed as the top priority, number one, and they will do whatever it takes to bring it down, even if that means creating a tough recession, even if that means having even larger deficits for the government. I think the Fed will go as far as they can go. And most people don't think this way. Most people think they will pivot like tomorrow, but I don't think that's going to happen. And until that, and of course, as with everything, I can be 100% wrong, but I don't think they want inflation to go uncontrolled, and they cannot, even because they would lose their position as world power.
Yeah, for sure. I mean, and also like, this, we're just, how we're talking, it just shows these layers of complexity, right? Because like, when you're looking at the Fed, like they want to, get inflation under control. So then you have this issue of tax receipts, and then you have this issue of like, everybody, it seems like they're trying to be Paul Volcker, right? And when you look at debt to GDP, in the 80s, the early 80s, late 70s, early 80s, it was a lot lower than where it is now. The deficits were a lot lower. We weren't as broke, and everything. And so like when Volcker was allowed to, to raise interest rates or allow interest rates to go higher, like we experienced some pain, but it wasn't this, our debt to GDP was a lot lower. And, historically, countries would like allow inflation to run hot to reduce the debt, so that the debt to GDP can come back to like a reasonable level. So how is that kind of playing out in your framework as well when you're thinking of like the Fed and macro?
Yeah, I think that for sure you're right, 100%. The Fed in the 1980s and late 1970s had a completely different picture at hand when having to fight inflation, and they could indeed raise interest rates way more than they can now. I mean, just think about what would happen right now with 15% interest rates. I mean, everything would break. But not only in the US, the most important thing is the world would break. Europe would collapse with the US having 15% interest rates, because the euro would just get, like, the euro currency would just get like completely killed. So for sure the picture was really different, but at the same time I don't think they can allow inflation to run hot for like a decade, let's say, because people wouldn't be okay with it and the economy wouldn't respond positively with it. If you think about it, they let inflation run out for, let's say, 2 years now, and that's already for them that's already reduced the real value of the US debt. So that, let's say they take another year to bring down inflation. That's 3 years of inflation above target that actually reduce the overall real amount of the debt when accounted for inflation. So already that would be something positive on their part.
Mm-hmm. Okay. Yeah, for sure. And that's a good segue. You mentioning how, the interest rates would affect the euro. And so on a global scale, we're seeing the European Central Bank actually, increasing interest rates. I mean, and then you have, we talked last time how like the different countries have different economic or financial situations, and I mean, especially like Italy or whatnot. And then you have Japan in there too. Like Japan, kind of playing this part in that framework as well. So what's happening there? What are the risks there? I think we talked about the risks last time, but what are the risks with the Fed on the current trajectory? How does that impact Europe or Japan?
I think Europe, let's talk Europe. I think Europe has a lot of problems, and not all these problems come from the Fed tightening. Right now, the euro is back below parity. It got below parity weeks ago, and now it's back below parity after a brief time above parity. And I think it's not cheap. I think the euro can go way lower than just below parity. And there are 4 factors that would need to happen for me to turn bullish again on the euro. The first one is a peace deal between Ukraine and Russia. So, I mean, we need to remember that Europe has a war, is living through a war, and this war is affecting energy prices in a crazy way. Just like, to talk numbers, the German baseload power prices 2 years 2 years ago were 45 euros just for megawatt hour, and now they are 660 euros per megawatt hour. So that's like almost a 15x increase in like a couple of months that happened. And that's destroying companies. Companies are cutting output because energy prices are too high. And this is affecting all companies, even like large international companies. Like, one news that came out recently is BASF, which is the largest chemical producer in the world. That's a German company. They are reducing their ammonia output because gas prices are too high. And so energy, it's really a big problem in Europe. So the first thing that would need to happen for me to turn bullish back again on the euro is a peace deal between Ukraine and Russia. Until that situation is solved, Europe is in a danger zone. The second thing that would need to happen is the ECB hiking aggressively interest rates, because right now they're at 0. So inflation is well above 8%, and they are at 0% interest rates. It's a joke. It's a complete joke. It's complete joke. And the third thing that will need to happen is energy prices to come down. And the fourth thing is inflation to come down. But until those four things happen, I don't see a bright future for the euro or the European Union or the European economy.
Yeah, yeah, that's good information. And I was looking at like so I was doing a lot of videos on like the food shortages or whatnot. So when I watch like Rick Rule when he talks about the volatility in energy and commodities, and so I was in this play. I was in Nutrien. It's a they do agriculture, fertilizers and stuff.
Yeah, I know them.
And so
Canadian.
yeah. So they went from like $110, and I sold off. They crashed down to like $60. I bought back in, and then this was within a matter of like 4 months, and now it's back to $101. And I was like, what? How the heck did it just pop back up that quick? And I was looking at some of the news. They said something came out about with Poland and fertilizer. I don't know if you caught that or not.
Yeah, I mean, in Europe, what is happening is that they're cutting down fertilizer production. So because of energy prices, they're too high. So the same thing I was saying about BASF, that's just one example of this large chemical company, the largest in the world, that it's cutting down ammonia production, which is ammonia is a key component for many fertilizer, just because gas prices are too high. And that's crazy if you think about it. So yeah, and same thing happened, for example, the other pure play in the fertilizer space that's big enough is Mosaic. I don't know how to pronounce it, the other company. So those are for sure interesting companies. I don't own them. I would love to own them at lower prices. And again, it's the same thing that I was saying before. I'm just playing this bear market cycle. So once we arrive at the capitulation phase and stocks prices come down because people need to sell, then I think it will be a wonderful time to buy these companies that play a key role in humanity. Because without fertilizer, like we wouldn't have enough food to eat every day. So yeah, so I think going back to what you said about commodities, I think those will be a wonderful play for the next decade. But we could see in the short term, let's say 1 year, price come down for these commodities and for the stocks of the companies engaged in these commodities.
Yeah, for sure. And that's kind of like like we're not in a place to heavily invest in the infrastructure and bring like more supply online and such, and address supply chains and everything, because we already have high inflation. If we keep printing and we keep just creating more money supply, then that's going to compound the issue too. So I can see commodities coming down, and then once if they're able to get things stable, to where we can start investing more into commodities and bringing more supply online, then I can see that being a very bullish for the decade.
Yeah, 100%. I am bullish for the decade. I think it's like we are in a commodity bull run, but at the same time, in those bull runs, there are up and downs. There are like that could happen, especially if the global economy goes into recession, especially that. And also, a lot of commodities are closely linked to China. China is one of the biggest consumer of copper, iron ore, and coal, because for many reasons. And one of these reasons is their real estate market, which is like their real estate market is huge. And Chinese people are highly invested in the real estate. But now we are seeing the cracks there. A lot of banks are going bankrupt. A lot of real estate development companies are going bankrupt. The Chinese youth unemployment is at 20%, and they're easing their monetary conditions because they're trying to stimulate the economy there. So I don't think we could see weird things in these coming years, with China being in the situation that it's which is right now, it's very vulnerable, I think.
Yeah, for sure. Yeah, well, Giorgio, appreciate you for coming back on and everything. This was a great conversation. It was like interview conversation, man. It's just like, we both consume a lot, and and there's a lot of questions to be answered. Questions asked and questions to be answered. And you provided a lot of good insight today. So I appreciate you for coming back on.
Thank you for inviting me. That was a pleasure.